For decades, the two-week pay cycle sat completely untouched at the center of the modern economy. You work for 14 days, hand over your labor, and quietly wait for payday to roll around before you can actually touch the money you earned. Every 2 weeks, time cards are calculated, withholdings and taxes are processed, compliance checks run, and funds are moved through the Automated Clearinghouse, or ACH system. This batch system exists because running payroll manually every single day for thousands of workers would be an operational nightmare for human resources departments. Because of that technical limitation, companies effectively operate on a short-term, interest-free loan funded by their employees. You do the work today, but the company retains the cash for 2 to 4 weeks before settling the balance. For corporations, holding on to that cash reserves liquidity and keeps interest-yielding accounts full. But for the average worker, it creates a constant cash flow bottleneck. If rent is due on the 1st, but payday isn't until the 7th, you are technically solvent based on your hours worked, but completely illiquid in terms of cash on hand. This liquidity gap is where traditional finance historically extracted massive profits. When an unexpected bill hits a worker who is 10 days away from payday, they are forced to seek bridge capital. For years, the primary options were bank overdraft fees, which cost tens of dollars per transaction, or payday lenders, which charge exorbitant annualized interest rates. The underlying core problem wasn't a lack of earned income, it was an artificial delay in getting paid for work that was already completed. DailyPay entered the market to solve this exact structural flaw through direct technological integration. Instead of replacing employer payroll systems, platforms like DailyPay integrate directly into human resource capital management software like Workday, ADP, or UKG. Every time an employee clocks in and completes a shift, the software ingests those hours in real time. It calculates estimated taxes, garnishments, and withholdings, establishing a net available earnings balance. When a worker decides to transfer a portion of their earned wages through the app before payday, DailyPay advances those funds instantly to the worker's bank account or debit card. The crucial distinction here is that DailyPay is advancing its own capital, not the employer's cash. The employer's cash flow remains completely untouched until the official scheduled payday. On payday, the employer runs their standard batch process as usual, sends the total earned wages to DailyPay to settle the advanced amounts, and any remaining balance is deposited directly to the worker. From a psychological standpoint, this shifts the relationship between labor and reward. Under the traditional model, work and compensation are mentally disconnected by time. Under real-time earned wage access, the value of an 8-hour shift can be realized immediately. Studies across the industry show that when workers know they can instantly access earned cash to handle an emergency, absenteeism drops, employee retention increases, and willingness to pick up extra shifts rises significantly. Employers benefit from higher workforce stability without having to overhaul their accounting infrastructures. However, earned wage access is not without its nuances and potential pitfalls. To use these services objectively, workers must understand the underlying economics and cost structures. DailyPay typically monetizes through a small transaction fee for instant transfers, similar to an ATM fee, or provides fee-free options for standard multi-day transfers or transfers onto proprietary digital cards. While a small fee for an instant transfer is exponentially cheaper than a payday loan or a bank overdraft fee, relying on daily withdrawals can inadvertently turn into a recurring microcost if misused. There is also a behavioral shift to manage. When workers withdraw their pay daily to cover daily lifestyle spending, they face a reality check when official payday arrives and their net paycheck is significantly smaller or close to zero. Earned wage access solves short-term liquidity, but it does not automatically build long-term wealth or replace disciplined budgeting. If a worker drains their earnings every day without setting aside capital for fixed monthly obligations like rent, car payments, or long-term savings, they simply shift their financial stress from a 2-week cycle to a daily cycle. Regulators and consumer advocacy groups have also taken a close look at the space, debating whether earned wage access should be classified as a credit product or a financial technology utility. Because these platforms grant access to funds that have already been earned through documented labor rather than extending unearned credit lines, They operate outside traditional credit scoring and interest rate structures. This regulatory evolution is pushing the industry toward greater transparency, fee caps, and built-in financial wellness tools like automatic savings features. So, what is the core actionable takeaway for navigating this modern payroll landscape? The key lies in viewing earned wage access as a strategic liquidity tool rather than an income multiplier. If your employer offers a service like DailyPay, the most effective way to utilize it is as a financial safety net. Use instant access selectively to avoid predatory fees, late penalties, or bank overdrafts when unexpected life events happen. Pair the technology with a zero-based budget that accounts for monthly fixed costs first, ensuring that on-demand transfers are used for true cash flow management rather than impulsive consumption. The shift from rigid biweekly batch processing to real-time earned wage visibility represents one of the biggest structural changes in modern compensation. By removing the artificial time barrier between working and getting paid, technology has given workers unprecedented control over their earned money. As payroll infrastructure continues to digitize, the concept of waiting 2 weeks for a paycheck may soon look as outdated as a paper pay stub. Understanding how these systems work behind the scenes allows both workers and businesses to leverage real-time cash flow safely, efficiently, and intelligently.